Recording. Welcome, folks, to Gold Digger Media ROD production. We're here today with our good friend Michael Venuto. Before we get started, let me just read this quickly. This discussion is for educational purposes only and is not financial advice. Nothing shared here is a recommendation to buy or sell any securities. All investing involves risk, and you are responsible for your own decisions. Please do your own research and consult a licensed professional before acting on any of the discussions that we have here today. So today, this afternoon or morning, depending on where you are in the world, or maybe evening, we have Michael Venuto, the Chief Investment Officer and co-founder of Tidal Financial Group. The platform was named 2025's Best Service Provider. Tidal has become one of the most influential ETF infrastructure platforms in the industry, working with dozens of issuers and helping bring hundreds of ETFs to the market over the last few years. Michael has a front row seat to the evolution of the modern ETF design, from early thematic projects and products to derivative-based income strategies, crypto-adjacent wrappers like the recently filed Bit Bonds and the stack funds done by Quantify. What makes this conversation different today is that we're going to sit down with him and we're going to talk about how this whole thing works, where he's seen it come to, where he thinks it's going, and help him give us retail investors a little inside information on how we should be looking at our portfolios and the rest of 2026. So we're so glad to have you. Thank you so much for joining us today, Michael. Please say hello to everybody.
Hello, everyone. As always, I really appreciate these forums. I'm a huge love for the idea of working together as a community. I feel traditional finance does not really serve this community very well. And at Tidal, we encourage all of our sponsors and partners that are launching ETFs to engage. And, we don't want to be the old boring company. We're always listening and we're always looking to innovate. We are a mission-driven company that is focused on fostering creative and financial freedom for our clients and our families. And I've lived that motto for 14 years. I've said it on almost every meeting I have with the employees, but it's more important that we live it than just say it.
Yeah, you have shown throughout the years that you do live your culture and values, not only in your business but in your private life, and I think that is really refreshing for most of us to see. Take a quick pause here, and I just want to make sure that anybody that's in the audience or coming in, that you know that you are 100% invited to come up on stage. This is not my platform, this is not Michael's, this is yours. So this is the time where you get to interact and be a part of or talk with somebody who is leading this entire new asset class. So we're really happy to have you. Michael, I just want to make sure that's okay with you. People can come on up and ask.
Absolutely.
Wonderful. All right, so what I wanted to do was start out with just a general question, because one of the most fascinating things that I learned about you over the year and a half or so that I've known is that you went to NC State to study philosophy and religion, which seems kind of like as far as the East is from the West, from the cowboy kind of ground of finance. My basic question would be, what got you to go there for that first, and then the transition, and how do you think that is like affecting the way that you look at things or fashioning the way that you're looking at things now?
Okay, this is a great starter because we're really going way back. How did I end up at NC State? Well, in high school, I like to do everything. I learned most of what I consider, valuable education from extracurricular stuff. So, I took all the AP classes and stuff like my daughter is doing now, but I really learned a lot from programs like policy debate and chess and being on the soccer team. And there was this thing called Odyssey of the Mind when I was a kid. So I really embraced all of those things very early on. And I feel like I learned a lot more from them than somebody regurgitating what's in a book to me. And that's kind of how I ended up at NC State. Was they did not have a debate team and they wanted one, so it was a way for a blue collar kid whose parents. My dad was an elevator mechanic. I didn't know anything about philosophy or religion or finance. I didn't even know what I wanted to do. I just knew that I liked the idea that they were going to let me travel the country and build a debate program and pay for me to do all this stuff. And a lot of my friends from high school went there, so started out there. I wouldn't say I was a great student though, because again, I learned by immersing myself way more than having somebody try and tell me things. Which is funny because one of my favorite quotes is that smart people learn from their own mistakes and wise people learn from others. I try and live that, but the truth is I like to make my own mistakes because you definitely stick with you better when you do them yourself. You can draw on the wisdom of others. So from there, when I was about 22, my grandmother passed away, and my grandfather was still here in New York. So I came up for the summer to help him get things organized and figure out what I wanted to do. And I got to go fishing every day, and I loved it. It was a great summer. I had reconnected with a childhood friend who, we'll call it, wasn't the sharpest hook in the tackle box, but he was my age, and was driving a Lexus. And I said, Steve, I don't ever say his last name, and I'm not going to say whether or not Steve's really his name. I said, what do you do that you're my age and you're driving a Lexus? And I didn't want to be, and by the way, you're dumb and you're Joey Tribbiani from Friends. You're delightfully not the smartest guy. I didn't say that part, but he said, I work on the stock exchange. I was like, okay, so what do you do there? And he goes, I don't know. And I was like, oh my God, I'm going to write a book about this. Look at this crazy Wall Street thing. This kid who doesn't know anything is there, and he's got a $32,000 bonus his first year and bought a Lexus. This has got to be the greatest story to take from a philosophy, religion, critique concept and write about it. So I managed to make a couple phone calls. Turns out I had a second cousin who used to have a seat on the floor, and he lost it in '87, but he was still working down there as a clerk. And after talking to him, he got me to the next person and the next person. And eventually I landed an internship running tickets on the exchange. Back then, there was no real computers. I mean, computers existed, but they didn't really use them down there. Everything was still little pink and white tickets. And, when you're on the exchange floor, there's this blue tape that goes around those big terminals that you see on TV. And the way it used to work was the brokers were inside the blue tape and the clerks were outside the blue tape, and they weren't allowed to cross that. They had to hand the ticket to a ticket runner who would, basically run the ticket to the booth. And that's when the trades went off. I know it sounds crazy, but that's how it was still being done in 2000 and 2001 when I was down there. And it's not like that at all anymore. In 2000, there was 10,000 people down there. Now there's 300 to 400 at any given moment. It's all computers now. The tape is still there, but it means nothing anymore. The really cool thing though was after being down there three or 4 days, I was like, this doesn't sound or look or smell or taste anything like what I was expecting. It was very much a clear meritocracy. Everybody down there was down there because they were a hustler. It was more like a pressure cooker. It didn't matter if you went to Harvard. It mattered is, do you have the stamina and enthusiasm and the the will to just keep going in this high pressured situation. And I started to learn that these people were nothing like what I was expecting. Um, and I started to fall in love with it. And eventually I got offered a job at First Union Securities. That's where I'd say I learned everything not to do on Wall Street. That was the traditional sales job where you're making 500 calls a day and you get your Series 7 and you learn all the basics. But that's just a terrible part of Wall Street. That's just sales. It's no different than selling cell phones or I don't know, pies, whatever. It's just the tickets are bigger, so you got a bigger commission. I absolutely hated that part, but I'm very glad I did it because it led me to understand what was one of the parts of Wall Street that really is terrible. Doesn't matter if you're with Goldman Sachs, First Union, or Stratton Oakmont. They're all just selling a story, and it's don't take those phone calls or have a good time heckling when you do get one of those phone calls. From there, I jumped to a small hedge fund called Horizon Kinetics. I was like the fourth employee there. They really embraced the creative freedom. They still do today, but they didn't have the same kind of care about culture that I did. And I learned a lot of terrible things about Wall Street there. But I also learned some of the beautiful things, which eventually led me to leave, become a partner at Global X. And while I was building Global X, I started to incubate what is now Tidal. So I know you asked a very short, simple question, and I way over answered it.
So.
We love
it's wonderful learning and getting a chance to peek behind. I mean, I'm not sure that most of us have an opportunity to talk to somebody who operates, runs, and co-founded a company that has over $40 billion worth of equity in it. So we're just grateful. So I wanted to jump forward to the next part. So how did you go about, and what made you, or what was the impetus to start Tidal?
Such a good question again. So I would say after 12, 13 years at Horizon Kinetics, I'd started to burn out. In fact, I was cleaning up an old computer and just seeing some of the emails and texts that I was sending my wife back then. It was just every day was stressful, right? Because the incentives were wrong and there was no culture to it. And that burnout got to me. And I said, there's got to be a better way to do this. And at the time, ETFs were just really coming into vogue. They weren't that popular. There really wasn't any need to look at them any further than, the expense ratio back then, because they really didn't differentiate. There was maybe 600 ETFs then. There's over 4,000 now. And when I started the company, the original iteration was we were going to be a company that does really deep dive investment analysis on ETFs, the same way traditional funds companies would do on individual stocks. I mean, I know all day now you guys do that stuff, but back then there was no companies doing that. And I really thought that would, be the value prop that I could monetize as basically just selling portfolios built with ETFs where we actually cared about security selection. Truth, that did not work. I started it in 2012. We were close to bankruptcy by the end of 2015, which is when we did our first pivot. I know it's exciting to see the company today, but this was 14 years in the making. And a lot of people don't know all the pivots and how hard it is to get there. But the first pivot was, okay, this in-depth research and concepts that we have, it doesn't seem to be something people want to buy portfolios of, but it certainly seems like something that helps issuers tell their story and get their information out to advisors. So we kind of took all that IP and we repurposed it and went to Direction and Global X and Van Eck and all these, call it ETF companies that were doing more than just beta, and said, let us help you show your value prop. I created a whole bunch of software and that, I'm not going to say it took off, but it went from bankruptcy feeling like, to, hey, we can keep the lights on. And it worked really well for 4 or 5 years. We used to call it the ETF think tank. But we would get paid by issuers to help them express their value prop to advisors. And after 4 or 5 years of doing that, we looked at the business and said, hey, we helped this company Robo, it's still out there, ROBO. They went from 100 million to $1 billion, and a lot of that was the work that we did here at Tidal to help them get there. We got paid once for it; they get paid forever for it, and that was a realization that we needed to take that business model of helping people grow ETFs and change it to help them launch and grow ETFs. Because once they're in your trust and you're behind the scenes, you're helping them grow. They're not really paying you for that growth, but you're getting a percentage of the ETF for being the back office and the compliance and the trust services and the trading and all that. So if the next ETF that we took to $1 billion, we'd have the ability to get paid forever on as opposed to one time. And that was the kind of third big pivot of the Tidal business. And that's the one that took off. Today, we actually hit a high water mark yesterday. We're servicing 69 billion in ETF assets, almost 400 ETFs. We're about 200 employees now. We've hired 45 people this year. We're going the opposite way of XYZ. Even though we were early to using AI, I think if we didn't use AI, we would have had to hire 150 today. Yeah, there's been a lot of pivots that brought us here, but there's kind of two things that have always been part of the company. One is that culture of creative and financial freedom and acknowledging the two cohorts being the clients and our families. And the second has always been being thought leaders in innovation, in ETF structure, in everything that is the values of the ETF wrapper applied to finance. Didn't work as SMAs, didn't work great as a, call it, marketing firm, or but has really found its way as a core service provider to all the independents that want to bring beautiful ideas to market and the best wrapper out there.
That's a wonderful story, and just an amazing lesson for anybody who's been an entrepreneur and/or are thinking about it. These pivots that Michael are talking about are essential. Without them, ultimately everything starts to erode. So I applaud you for not only doing it, but also sharing that with us. The next question I kind of had is, we hear these terms like advisors, traders. There are different kind of levels there. And as with Tidal, do you think you could kind of go through like 2 or 3 of those and kind of explain them to us, so when we hear those terms moving forward, or we're reading a prospectus or an Edgar, we understand what role each of those things have?
Yeah, and I think I understand the question. If I'm going the wrong direction, just interrupt me and we'll get back on track. But to use a term that's commonly used in the crypto world, in the world of ETFs, there's a lot of trusted third parties, right? Trusted third parties exist in finance because regulators want a throat to choke. That's actually something Jay likes to say all the time. He wants one throat to choke on every trade. So having an ETF out there is filling in a number of different roles to make sure you're compliant with all the regulations on what parties should be doing. So to have an ETF, the first thing you need is a trust, right? This goes back to the laws that were created in 1940, which is crazy, right? Where 90-year-old laws, right?
Wow.
Um,
Wow.
and those laws are in response to the crashes of 1929. Like most people don't know it, but in 1929, JP Morgan was allowed to short his own stock, right? Like that's just crazy, right? There was no disclosure. There was no throats to choke, right? Because they could do whatever they wanted. So in the ETF structure, you need a trust, okay? Trusts are expensive. They have to have trustees. They have to have lawyers. They have to meet all kinds of regulatory hurdles. They're designed to protect the shareholders. You know, each trust costs a significant amount of money to build and keep open. And then there's a significant amount of liability if the trustees aren't given the right information or are making bad decisions. There are bad actors out there, and the trust system is designed to, try and prevent that or have somebody to go after if they do something not in the client's best interest. So that's one piece of the Tidal puzzle is having, I think we service currently 13 trusts with multiple trustees on each one. Each one's required to have at least 4 board meetings. Most have 8. Each one of those board meetings has 1,000 pages of paper that come with it that people are supposed to go through and make sure that everything is in line with the regulations. That's one piece of that stack that we cover. The second piece of that stack is compliance, right? So I know it's very frustrating to all of you. It's extremely frustrating to me, but those 1940 laws govern how we talk to people and what we're allowed to say and what we're allowed to post on Twitter and what we have to disclose. Like every little detail is a lot of different compliance components. And personally, I think a lot of those rules hurt people more than they help people. But I understand why they exist. And if you're a new ETF issuer, creating a trust is expensive. Hiring a compliance team is extremely expensive. We have a double-digit amount of compliance people here who are doing all that for our clients. Then comes the next part. You have to do all the actual trading in the portfolio, right? So we have 45 people, 20 who just do options, people who support them that do the reconciliation. So that's all the trading and the building the portfolios to match what the clients want. I was just on with Michael Coe on another thing. In options trades, we did 1,000 options trades yesterday. If you're a new company wanting to start an ETF, I mean, how many people do you have to employ to do all that? It's an enormous amount. So we scale that for people. Then there's the advisory role. So in the world of ETFs, somebody has to stand in and say, I'm taking responsibility for looking at these portfolios and making sure that they meet all the RIC rules and meet all the tax rules and meet all the administrative rules. That's an advisor in my world of ETFs. The term advisor in the traditional, call it investment world, is usually like a financial advisor. They have the same fiduciary responsibilities, but it's to the end client, not to the fund. And a lot of people who come to us wanting to launch ETFs are already advisors, but want to be in this space. They don't have the knowledge in this space, so they rent it from us. So that's just some of them. There's a number of these components, but Tidal is really the first company to build the full stack, right? Where you can come to us, like, when Tom Lee decided he wanted to be in the ETFs, it's not like he couldn't have built all this, but it probably would have cost him $2 million and he'd have to hire 6 or 7 people and they would have gotten a number of things wrong because they don't have the same experience. Whereas with us, he comes to us, we talk through the idea, we did everything. All he has to do is give us the 50 stocks he wants to own. And it's, he'll tell you it made it all very easy. It's just the ability to accelerate and scale people up, it's massive.
That's fascinating and a great insight into the stack that Tidal is built and the services that you operate. Here's a question I get on the fringe, but it comes up often and I'm not able to answer it. Maybe you can. Let's say I and three of my closest friends have this, super cool proprietary kind of individual idea for an ETF, and I come to you. Could you walk me through one, what that process looks like? So maybe there is somebody out there that's wanting to do it so they know. But then two, how much money or capital do I need behind me to be able to get something launched?
Yeah. This is always a really good question because it really gets to the heart of who is this for, right? And I hit on this term trusted third parties earlier. And in the ETF world, to be compliant with the regulations, it's going to cost about 200 to 240,000 a year in just general expenses to keep it alive. And that's all money going to various different trusted third parties. So, number one trusted third party is a custody. Who's going to hold the stocks? And for us, we use US Bank, we use Bank of New York, we use uh, JP Morgan. So, like, there's a number of big institutions that deal with custody. They take a chunk. Then you need to be listed on an exchange. So either NASDAQ, CBOE, or New York is going to take a chunk. Then there's legal fees that need to be done to do all the filings and print all these prospectuses and all that sort of stuff. They take a chunk. And then Tidal comes in and takes a chunk, right? Because we're going to do your compliance, we're going to do your administration, we're going to do your trading. So it's all of those things. So I start with most people, hey, it's going to be 240 grand a year for you to break even. I mean, for you to keep this thing alive. So if you have a 1% expense ratio, you stop writing checks at 24 million. If you got a 50 basis point expense ratio, you stop writing checks at 48 million. I never want our clients to write us checks, right? So if you don't think you've got that, don't try and launch, because if you're going to try and launch and not expecting enough to break even, then you're writing checks, and when you're writing checks, you're highly unlikely to spend any money on marketing, and you're highly unlikely to spend any money on sales, and you're going to be stressed, and you're going to be worried about your spread and not getting on shows like this and talking to people and getting the message out. So it is totally possible for anyone to come launch an ETF, but it's expensive if you don't have enough to get to scale. Call it, most ETFs aren't really making money till they're over $50 million. And there's a lot of ETFs out there that are under $50 million.
Well, are you saying that when I look at like an issuer's portfolio and they have 15 and three of them are $75 million or plus and another 12 are under 30 million in that 7, 10, 12 range, that's costing them money? They're I won't say losing, but they're having to write checks for the privilege of having those offered on the exchange?
Good question. Yes, they have to pay all the trusted third parties, right? Wow. The custodians have minimums, the stock exchanges have minimums, the legal has minimums. Everybody's got a minimum, and if you don't hit scale, like it's very, very difficult to get that first 50 million in. And that first 50 million is usually the determination of whether or not it's going to succeed or not. Usually if you don't get to 50 within the first 3 years, you're probably never going to get there. So that's why you tend to see most ETFs close year 3. After year 4, they're highly unlikely to close.
That's great information. I love it. Not that I actually have 4 friends that could come up with that, but I just thought it was a great way to kind of unpack this whole kind of asset class. Thank you. So my next question is, You and Tidal have been at the forefront of this new asset class in the positioning and the democratization of this for retail investors. I'm just really interested. It's been about 3.5 years now. I'm just really interested in a kind of like scope look from your viewpoint, how this has changed, where the zigzag in the road happened, and are you liking the direction it's going right now?
Okay, so this is really one of those times where I get to say something good about the regulators. You know, I complain sometimes about their compliance rules and this and that, but the reason all these new ETFs exist in the option income or option protection or option leverage, they all exist because there were regulations that came out in 2020 and 2019 that changed the game. So the idea of buy rights has been around forever, right? Personally, my first ETF trades were in '08, where I was buying.
Just in case somebody who's listening to this doesn't know what a buy right is, could you just quickly explain that?
Sure. So buy right is often also called a covered call, but essentially what it means is you own a stock and then you sell. We call it an option, but it's essentially a contract to do something against that stock, right? It's usually to hand it over at a certain strike price or buy it at a certain strike price, but it's a way of taking a stock that and if the stock doesn't move, you can still make money off of it by selling an outcome in the future. So um, it's funny because Michael Coe, I said I was on with him before this. He took it all the way back to Archimedes and olive presses and gave the history on it. He's got some great slides as a preview for his next week's show. But yeah, it's really options were originally created to help people in business essentially protect or hedge out their exposures, right? If your job is to farm corn and you're worried about the volatility of the price of corn, you use an option to hedge it out. Most of what goes on in the world today with options has taken them from that world that's just doing it for the underlying business they have, and now it's speculators doing market discovery to find the choices and things like that. When in 2008, for example, the market was quite unpleasant. One of the ways that I was able to generate returns back then was buying treasury, bond ETFs and writing options against them. So, you buy TIP or TLT and sell a call against it. And you got a lot of premium because in 2008, bonds were up big when stocks were crashing. And it was just a great first concept. When I started to look at, can I put this idea in an ETF? Well, in 2008, 2009, you couldn't. In 2018, you couldn't. In 2020, you could. And once you could, the floodgates were open for all kinds of innovations, as well as taking things that has historically only been available through a hedge fund or a mutual fund charging 250%, could now be put into the ETF wrapper. And the innovations were built on the shoulders of a lot of smaller innovations early on, right? Like at Global X, we had the cover call on the Qs, but it was systematic and it could only go to a certain level. And there was inefficiencies with what we could do. There was the S&P buy right. I think it's PBP or something like that. That's been around forever, but it's never gotten a ton of assets because it's not terribly efficient. It's using these old rules that they had to retrofit to. When they changed the derivatives rule, that opened up the ability to do buffers. It opened up took a monopoly essentially where only Direction and ProShares could do leverage and said now everybody can do leverage, but you can't go higher than 2x. So you're unlikely to ever see another fund that does more than 2x leverage. But until 2020, only two companies could do leverage and they could go to 3x. Now everybody can do it, but we can only go to 2x. So they did some good things with that regulation, and it really has democratized access to it. I can remember 3 years ago sitting down with Jay, and I was like, look, man, there's 30 or 40 different option strategies listed in the CFA handbook. I believe someday every single one of them will be in ETF and on indexes first and then single securities. And we're seeing that happen in real time.
That's and as this arc over this 3 years has gone, and you've seen the SEC kind of take slightly different viewpoints of things, allow some stuff that you might be surprised of, but then starting to talk more about stuff that they didn't like. How has that arc gone for you, and where do you see it going over this next half of the decade?
Yeah, so it's funny because the SEC never endorses a product, right? Them approving one is a systematic process. It's not like, hey, we got approved. That means the SEC endorsed our idea. No, it means that you fit the idea to the rules that they set up and you've won the discussion on that it fits within those rules. That's it, right? So it's actually a good way, in my opinion, to deal with it because it takes the politics out of it. It takes the emotion out of it. It takes all the, is this, like, look, there are plenty of products out there that should not be held for more than an hour. Yeah. But they have a purpose for certain people. And that's the stance the SEC takes, right? Like they're, when somebody comes out and says, I want to do, a 2x leveraged whatever stock or whatever index, and I want to add this to it and add that to it, and they pummel on a whole bunch of different things, and we all know this is a product that should be used for an hour during an earnings call, and you have to disclose that in there, but that doesn't mean that because the SEC let it happen that they're endorsing that somebody should buy this and hold it forever. And I think that's where people get a little confused. You have to, I know nobody wants to do it, but you have to read the prospectus, right? So plenty of these products out there say, don't own me for more than an hour. And yet you see things like triple long financials being held by an individual for 4 or 5 years. It's almost a guaranteed loss. I mean, and it says it in the prospectus. So those parts of it are hard. And again, it gets lost because we have to disclose, our disclosures are 17 pages long and only one line matters. And it's the line that says, this will go to zero if you hold it for 3 years.
Right.
We need to get rid of all the other gobbledygook and put that cigarette warning on the top of these things that say, hey, you own this and you're going to die.
That's the next portion of the industry is somebody will monetize that, being able to put that out there for investors. So in this 3-year arc, would you mind kind of sharing with me the either the fund or maybe not specifically fund, because I don't want you to call anybody out, but the concept or the idea that you were absolutely surprised it worked and was adopted, and maybe the one where that you thought really was going to have some traction and a great runway that didn't go well, and then kind of discuss why you think that is.
Okay. So I think the I'm going to give credit to Bruce Bond as really being an amazing innovator here. So Bruce Bond, for those of you who are not super familiar with the 20 people who deal with ETFs in the financial area, Bruce Bond was the original guy who came up with Power Shares, which is now owned by Invesco. And Power Shares, their innovation at the time was kind of smart beta, right? Like bringing in different types of weightings and gobbling up some great ideas. And Bruce also made the deal to acquire QQQ. So really early on, a true innovator in the ETFs. And he sold it to Invesco and kind of disappeared for 10 years. enjoyed what he sold. And at some point, 4 or 5 years ago, he came back with this idea of buffers. And buffers have existed forever in banks. They sold them as structured products, high fees that nobody can see what they are, and stuff like that. Um, and the buffers are basically funds that take an index and say, we're going to cap your upside, but we're also going to cap your downside. Eric Balchunas from Bloomberg calls them boomer candy. It's like a replacement for bonds or whatever, but they're basically just option straddles around an index. So I'm going to own the S&P. I'm going to get 80% of the upside, but only 70% of the downside. It's something like that. That was kind of the real takeoff. That world is now 60, 70 billion. Bruce just sold that to Goldman Sachs. I know BlackRock was very close to buying it, and Goldman Sachs outbid them. But that was the first big innovation in bringing option strategies. And they really focused on advisors more than retail, even though I think both bought it, but it was really sold to advisors and retail was kind of tangential. From there, the next thing you saw was single stock leveraged. Now, this is an idea that's been around. I mean, I remember Greg King from Rex pitching me this idea in 2009. So it's not like a new idea. However, it wasn't until these regulations changed that people could do it, which I think is funny because Greg had the idea 10 years or almost 20 years ago at this point, and he wasn't the first to get it out. It ended up being Will at Granite Shares, and people, and so it's funny how these ideas come and go. I think Greg is really good at having the ideas and really terrible at the timing because he also is the one who came up with the first stacked products. He had S&P plus gold, and he had emerging markets plus gold. And now the bulk of that money is not with Rex; it's with Chikansky over at Quantify or with Corey over at Newfound. So sometimes these ideas are too early.
Yes,
after the 2x single stock, that's when the YieldMaxes and the things like that started to come out with, okay, let's do income off of volatile underlines, which then said, okay, well, you can do income off of volatile underlines. What else can you do off of them? And that's where you spurred all these strategies like Nicholas has, where it's more of different option strategies or combining multiple ones like we do in Ulti, or the strategies like Chikansky has where you're writing covered calls off of a double stacked product. So you've got a combination of leverage and income. All these things keep coming. And then you get things like the shorts, right? So, okay, we've given you the ability to have long exposure. Let's give you the short exposure. Then when you look at that, you say, okay, well, if I got long and short, can I put them together? And I believe Curve did that. It's something I've wanted to do. I want to do a 130-30 ulti salty. I pitch that every other day to Jay, and he's not ready yet. But like the iterations are just endless. And right now they're building so many building blocks that people can take, Winter and Misty, put them together and build their own kind of condor or various different option strategies. Those will all become their own products at some point. And I don't know if YieldMax will do it or who will do it, but somebody's going to do it. And now it's gone as far as they have auto callables in ETFs. So I've been hearing, it's kind of like you hear the term Bitcoin is dead. I've been hearing ETFs are in the ninth inning for 20 years, and I don't think they've gotten out of the locker room.
That's super exciting, and I love the insight. Are you implying that there's going to be perhaps a company or somebody come up with the idea of creating an ETF of multiple different ETF providers to create a package for retail investors so they wouldn't have to manage and sell in and sell out of stuff on their own?
I think so. I've been definitely in conversations with folks. And, I mean, Jonathan, I tried to do that with fire. It didn't really kind of
Yep.
catch on. But so what? I had bad timing. I might do it again someday. Um, it's just finding it's so hard with ETFs in that you can have the best idea, but it's got to be timed right for when the market's looking for it. Right.
Right.
So like the first ETF I ever launched at Global X was very similar to the fire concept. I launched PERM was the ticker, PERM, and it was based off the permanent portfolio. And we knew that the permanent portfolio was this great thing that in '08 was down 2% and everything else was down 30, and all these assets flew into the mutual fund version of it. And we thought, well, let's make a simple, low cost ETF version of it. And I still think it's a great idea, but nobody bought it. And the permanent concept is just an unleveraged version of what Ray Dalio does. Ray even admits that he took all the theories from the permanent and leveraged them up. Huh? What do we got? People willing to pay for the leverage version and buy it from State Street, or we have RPAR here, the risk parity funds, but the unlevered one at a low cost, people weren't ready for. It might come again. You just never know on timing.
Great. I just want to pause here just for a moment and say, anybody that's on stage, please feel free to unmute yourself if there's a question or something that comes up that you want to ask. Or if you're in the audience, just raise your hand. Parabolic will be more than happy to bring you on up and let you be a part of this whole conversation. Really enjoy it.
I do have a question.
Yeah, go ahead.
Yes. Michael, you certainly are an innovator. It's just so great to hear this backstory for you. Just loving every minute of the show, and a huge inspiration to us all to continue to find our own personal pivots. And often, I'm curious: is there anything in store? In your wheelhouse for possible fund that is sort of the shovel for the water industry, the water issues we might be facing in the next 3 to 5 years, or even in marine shipping?
Okay, that's a great question. So on water, so I tend to think of the water ETFs that are out there as some of the first thematics to ever exist, right? My business partner Guillermo always claims lithium because that was his first ETF, is the first thematic. I think water was before it, but I like to let him have the story the way he wants it. The water indexes that exist today, I think there's 2 or 3. There might be a third active one. I think Tortoise or somebody like that came out with a more active one. I mean, they're pretty bland. They're more like utilities. It's a hard theme to find the right companies to get the good exposure for. I hear people pitch ideas like that from time to time. Like I could see Vista Shares doing it. I haven't heard him say it, but like the original iteration for Vista was John McNeil, who used to be the president of Tesla, called us up and said, "Hey, I have a venture fund. I know everything there is to know about AI, and I want to do this better AI ETF." I think his ticker's AIS. And we told him it wasn't really a good idea. I'm eating crow on this one now because he's obviously was right. Because the assets say he was right. But we told John, we're like, "Look, man, you're going to be like 15th to market." And he's like, "No, but I've got a better product, right? I'm going to get the infrastructure right. I'm not just going to throw names in there that have talked about AI on some call or whatever." He really was passionate about it. And we said, "Look, you've got enough money to take a risk like this, but we would suggest you try some other things. And we would also suggest you get a CEO who can be your person on this, since you're really a venture guy who's going to be doing a bunch of different things." And that's how Adam Patty, who got there. And I'm so happy for them. Like, if you would have asked me 2 years ago when I first started talking to the Vista Shares folks, is this going to work? I would have said highly unlikely. And the beautiful thing is, like Tidal, they pivoted, right? So they came out with their AI ETF. It kind of floundered. they came to us and said, "Do you guys have any other ideas?" And we started talking to them about the Omaha idea. They loved it. We got it out there. It took off. It kept them going. And then AI really took off, and performance made the VistaShares version stand out. And it got assets too. And then they've done other ecosystems. And you know what? It seems like John has a better way of getting that kind of theme going. So I guess my suggestion is pitch it to Adam Patty, so he'll pitch it to us to do a water version his way, because they definitely seem to have something that's different than others.
Thank you. Brother AB, are you unmuted?
I am. Can you hear me?
Yeah, welcome to the stage. What's your question?
Well, appreciate the opportunity to chime in. Thanks for making some time for us, Mike. It's been a great conversation so far, and in the spirit of continuing educating investors, would you be willing to share how you define the appropriate use case for high yield ETFs, particularly when distribution rates can include return of capital, and kind of how you balance fiduciary responsibility with the old caveat emptor that, it's the investor's responsibility to read the prospectus?
Okay. So let's start with the idea of a single security covered call or income ETF versus portfolios. So there's no cigarette warning in the prospectuses for Misty or NVIDIA or whatever that says you can't hold this for an extended amount of time. The reason that's not in there is because as long as the stock is going up or trending up over time, you can do just fine, right? Like you even do better if it goes up really, really slowly. You could outperform the underlying, right? So that's why they don't have the same warnings that these leveraged ETFs have. That said, if the stock doesn't trend up, you're going to have beta to the underlying. You're going to have that relative beta. And if it's choppy on the way down, it's not going to be pleasant. So I'm not a big believer that there's a lot of single security income ETFs that you can buy and hold forever. It's rare. Like NVIDIA might be that. Like it's, but that's about the closest one I can say that like I could even get comfortable buying and holding forever. Misty is not a buy and hold forever because Bitcoin cycles and it's going to have a leverage play to this. So you have to have an opinion. And if your opinion is this is the right time to own MicroStrategy and I want income off of it, then Misty is an appropriate investment. If your opinion is it's a terrible time to own MicroStrategy, but I still want to have income off of it, then Winter is an appropriate investment. We don't make the call on whether you should own Misty or Winter. People have to make that call for themselves. We're producing tools, not solutions that are buy and holds forever. Now, that's the single security world. It absolutely applies to leverage, right? That should be held for less than a day. And single security income products should be held for a cycle and it should be based on whether or not you're bullish or bearish on that underlying stock during a specific cycle. Now, the people who want to buy and hold something for longer term periods, that's where you get into the portfolios because the portfolios can use diversification to dampen the volatility of the overall basket, which can make them more of a buy and hold vehicle with the purpose and focus on income. If you read the prospectuses, they state income first and they state capital appreciation second. We go out of our way in helping these partners and groups craft the portfolios to meet those objectives. Sometimes we do a great job, sometimes not as great. Sometimes we go back to the drawing board and say, give us more tools, let us change something, right? I mean, I'm very proud of what the team has done to change Ulti, right? Like, I mean, when I went to the team and said, we need to add elements of the permanent portfolio to
Oh, yeah. Yeah.
The initial reaction was laughter, and I feel fully vindicated, right? Like
Yeah.
I brought a ton of gold and silver into the portfolio, took the gains, and got out of half of it. And it just shows that power of uncorrelated assets in a portfolio. So
Heck yeah.
when you're buying, when you're buying an income product that's more of a portfolio, it's just like the old days of picking mutual funds. You have to have an opinion on the manager and the subsector that they're going after. So if you think that me and Dan and Michael Coe and Jay are idiots, don't own Opie.
I credit Rod actually for my exposure to the changes in Alti. He's been doing a great job covering that and, showing us how the pivot has made the difference. So well done with the Alti shift. That was amazing. Ambassador, did you have a next question, or should we move to Miss Brownhill?
Oh, you move to anybody that you like. I have questions if we need them, but I want everybody to have an opportunity to get involved. I just want to make sure that Michael was done answering that question.
Yeah, I was done with that question. I do have to say that I have a 2:15. I got to drop off because I have to pick up my daughter from school.
Perfect.
Or I'll be in the car with you guys and then I might lose you. So
yeah, so we got about 10, 12 more minutes, give or take. So please, anybody that has a question, now is a great time. And if you don't, I've got a couple wrap-up questions that we could use. But yes, by all means, anybody that has one, come on up. Let's make it a party.
We've got Amy. Go ahead, Amy. Welcome.
Hey, thank you so much for having me, and it's been a wonderful interview so far. Are there any brands or like these issuers that you're more involved with than others? Like, do they choose to have different levels of association with you?
Yeah. So I kind of talked about Tidal being a full stack. And when I talk about full stack, I mean compliance, trust, trading, help with marketing, help with sales, help with compliance. The clients come to us and, out of that 69 billion that we're servicing, it's at all different levels. There are clients that just use us for trading. There are clients that use us for 9 services, and there's clients that use us for 1. And there's clients that use us for 4 out of those 9 and this and that. Number 9 is the one that I think you're kind of alluding to. And we, like I said from the beginning, transparency is one of the ETF virtues, and it's one of the values that we embrace. So we're not really, we don't promote it out there because it doesn't help with the story, but we're very transparent about what we're actually doing. And one of those services, number 9, is what we call fund financing. We'll come in as a partner in the fund, not like an equity partner, but as like a revenue share. So we'll come in and say, hey, we love your idea. We understand that you don't want to take all the financial risk on yourself of paying that 250 plus whatever bonuses to all those trusted third parties. We'll come in and cover 25% of that. But when things go well, we expect to get 25% of the profits as well. And I would say about a third of our clients are in that world. And most of those are ones where we help with the product development and the idea generation. Everybody gets the same service because everybody's paying for the same service. Some funds we have an economic benefit in that's higher than others, not different than any other business in the world. We don't treat them any different, right? Because we don't have any contractual obligation to do anything more for that fund than we do for the funds where we only are a service provider. So internally, we call those Tidal Select products and things like that. And we're very proud of them, but for us, it's just another service in the toolbox. So yeah, I think that explains it. I'm happy to answer any follow-ups, but that's the core of what we do.
Amy, go ahead.
Yeah, that answered my question. Thank you. And how are you using AI to improve the workflow with Tidal and everything? You mentioned that you were using AI before.
Yeah, I would say we were early compared to most financial institutions. Um, it's funny because 4 years ago, our general counsel went to the ICI meeting. ICI is Investment Company Institute. It's basically the lobbying group for mutual funds, but they also cover ETFs, even though they don't want to. They're now starting to embrace it because the world's changing. But our compliance, our general counsel goes there. He comes back and he reports to our executive team, to me and G and Jay and whatnot. Hey, I was at this thing and the guidance is stay the hell away from AI. Don't use it in marketing. The government doesn't understand it yet. We can't touch this. And we're like, okay. But then chat came out and we got enterprise licenses for the whole company. And today it turns out that our legal team uses AI more than pretty much any other group in the firm. Because, I mentioned the 11 trusts that have 4 to 8 meetings a year, and each one of those meetings has 1,000 pages of paper. Most of that can be generated by AI and then reviewed by a fiduciary general counsel's team to make sure it all matches up. The amount of time and money saved in legal has been huge, right? Like, I know it looks simple when we change something in YieldMax slightly and we have to do a filing. The amount of iterations that would take without AI is enormous. And today that's a huge part for legal, but the even better things, like our product development team, Mark on there works with Aga. He created an LMM to help us spot trends to talk to clients about. And that's how we got ahead of almost everybody else on the quantum stuff with Defiance, right? He spotted the quantum trend and we just hit another one that I'm hoping they come up with a product for. So we use it there too. Marketing uses it constantly for coming up with ways to get stories out there. Our business development team has all the knowledge from when Guy and I were basically the only business development, right? It was, we're 9 people and I'm talking to SoFi, trying to convince them to launch their first ETFs with us. It all went through Mike and Guy, and we wrote down everything. We used to do what we call assessments, right? We ask 100 questions. All that knowledge is in our walled off AI, and somebody new talking to whoever who wants to get into the ETF industry, and they've got all these questions. That AI can answer those questions that your generic version of chat can't. Your generic version of chat or Claude or whatever has the internet. Our version has all of Tidal's security master, all of our a portal that has every one of our clients' funds and what we have done and can do. It's got all the prospectuses from all of our funds. It's got all the assessments that we've done on every idea. It's got all that information. So it basically takes somebody who's 2 years in the business and makes it so that they can answer the same questions that only Mike or Guy could have answered 5 years ago.
It is changing the landscape. We just saw Block make drastic changes. I appreciate that. I did want to not let this go without asking a question about this. I see ROD up, so I want to make sure he gets in. But before you go and before we do a wrap up, I just wanted to get your take on Bitcoin, the Jane Street, all that stuff, and what do we, from a highlight standpoint, as a retail trader, need to know or understand about this in our day-to-day investing?
Great question.
Yeah, that is such, yeah. So I discussed this the other day on Lauren's show on Bitcoin Today, is I want to say this the right way. Bitcoin did not need an ETF. ETFs needed Bitcoin. Right? The whole thesis of Bitcoin is banking yourself and avoiding trusted third parties. The ETF is a trusted third party that is an aggregation of multiple trusted third parties. When you own the ETF, you don't actually own Bitcoin. You own a promise to have Bitcoin. I just feel so weird saying all that because I'm supposed to be the ambassador for the ETF industry. But it's true. It's a different philosophy. It's decentralized finance. ETFs exist in traditional centralized finance. I think of my firm and the people we work with as good actors in that space, but there are plenty of bad actors. So like it depends on who you trust. And all of that comes to this big issue, which is, I heard it for years. We need a Bitcoin ETF. When the Bitcoin ETF comes, we're going to moon. I don't know why everybody wants to go to the moon, but then we got it. And it didn't really moon. It mooned before it, and then kind of leveled off. But once you decide you're going to, I don't know, on a boat to get to England, you're going to do a why am I having trouble saying it? You know what I'm saying? I'm trying to go to England. And Atlantic, yes. I don't know why it got stuck on my tongue. Once you decide that, you know there are sharks in the water. You know what sharks do. They eat everything. Okay? So you prepare for it and you don't go in the water. Yeah, that's what happened when you got a Bitcoin ETF. Jane Street, Virtue, Cantor, GTS, Citadel, Old Mission, Murray. It's not just Jane Street. They're all doing this. I don't understand why people expect sharks not to bite. Yes. So is there this giant conspiracy that they were dumping every day at 10 a.m.? I don't believe it. I believe they were dumping whenever the algos told them to. And I think the 10 a.m. thing coincides with closing of the markets in London more than it does with a message top down at Jane Street. Like a trader's not even going to listen. They're just going to do, well, I don't care what the firm wants. I want to make my bonus, right? Like these people, their interns make 200 grand. It's just so silly to me that there's this giant conspiracy. Because I just don't believe it exists. However, I do believe the price action in Bitcoin changed because of that narrative. And I do believe that Jane Street will do whatever it takes to make money on spreads of the Bitcoin versus the Bitcoin ETFs and all of that sort of thing. And I do not believe that Mike Alford has some friend at Jane Street that was feeding him information and then closed his phone number. I definitely had friends at Jane Street and spoke to them, and they said the exact things I expected them to say. We're going to try and make money where we can try and make money. This narrative has been way blown out of proportion, and we invited these people in, right? Like, this is what comes with it. You go in a shark cage to see sharks. They're going to try and eat you.
Yes.
It's
Thank
like
you for addressing that.
Where they took the scorpion across the river and the scorpion stung them, and they said, "Why did you do that?" And the scorpion says, "Because it's a scorpion, right?"
Yeah, exactly.
Okay.
Excellent
Before we
analogy.
wrap up, ROD's up on stage. I wanted to make sure he had an opportunity to pipe in, say hello, participate, and then we'll go ahead and close out because it's almost 10 after the hour, and I know you need to cut.
Welcome, Rod. Welcome.
Thank you. Wait, so we're not going to the moon? Is that what you said, Mike?
I just said I'd like the number to go up, but I don't need it to go to the moon. I don't know if anybody's been to the moon.
No, I just want to say thank you for joining. I know it's obviously a different setup, but we're trying something new. Hopefully, get community questions. Actual voices. So hopefully, we could do more of these in the future too. Obviously, thank you, Ambassador and Parabolic, for running the show. I did have a quick question. I'm not sure if you have enough time to answer it, because when I did see, I know you mentioned YieldMax and the changes. I was in shock that you guys did not do this under a new ETF. So was there any thought of keeping YieldMax the way it is for the people who actually want the true exposure of every single underlying and making a new one? Or was it always going to be this way? I'm just curious your thoughts on the YieldMax change and keeping the same ticker.
Yeah, man. You know how like the Supreme Court, when there's a decision, there's a dissenting opinion? I would be the dissenting opinion, and I'd be in much more agreement with you. And I was the dissenting opinion. I really think that me personally would have kept YieldMax as it was and done another product. But I think the other, like all this comes back to we don't own products. There are no Tidal products. We've only ever done one product as ourselves, and that was the fire funds. And we didn't charge a fee for it because we thought if we charged a fee, we'd have a conflict of interest. So it's really the YieldMax partners that make this decision. We have a voice at the table, but they looked at it and listened to a lot of what people were saying. I mean, the amount of inbound complaints we get about Murney being in YieldMax, it's huge. And so you start to see the changes today. And, some of the things that I understand got them excited about the changes was the ability for YieldMax to also have the shorts in it, which really protects the NAV when the markets are going in the wrong direction. It also lets YieldMax have the portfolios in it, which again diversify it, even further than things, and it gives it the ability to avoid things like Murney when they're or AIYY when it's just a long run down. So I understand why the team made the decision it did. Personally, I fought very hard to just leave it alone and give people another tool. I didn't win, and I was never going to win because Tidal's not YieldMax. We're the service provider and revenue partner.
You could have done YieldMax as is and YMix for the new one, right? There you go.
Mark, you and I are on the same page.
Also, but also again, I want to say anybody that's complaining about Murney hasn't held it since December, because since December it has outperformed on every level. So just throwing that out there. All right, so
I agree with that's the power of diversification. That's right. It is what it is.
Okay, so takeaway question. This is the one that I want to make sure I ask for me. So that completely just for me, not for the group. And I apologize to everybody else who's still here. If I want to, as a retail trader, be able to get my foot in the door when SpaceX IPOs, what's the best way for me to go about it?
Heck yeah.
It's really hard to get it at the right price, right? So there are plenty of platforms out there that have these public offerings. Right? I know Austin Hawkinson has something. I think Public and SoFi have things that have this exposure. There's definitely like a illiquid version of the market for this. It's also in XOVR, which is Joel Schumann's company. He was an entrepreneur that created Entrepreneur Shares. I can't endorse that, to be honest. I just think there's problems with how they're accounting for things. And if you want to read about it, Dave Nodick from ETF.com has written extensively about this. It's kind of hard to front run the IPO there. We are now the service provider to Ron Barron and the Barron funds. He has exposure too. He actually holds it as a liquid security and has negotiated with the various regulators to show his ability to get liquidity. I think he has it because of his size and the other assets. So I'm not pitching that one, but I am saying that I think he's doing it in a better way than XOVR. And I think it's just that he has an advantage because of, being where he is and who he is and how much assets. I believe Kathy Wood has an LP version too. It's just rare that you can get good exposure to something like this. That's not going to cost you a ton and doesn't have a whole bunch of extra third parties that you have to worry about.
All right, well, we're gonna drill into this more over the next couple months because I think it's a topic that retail traders are interested in. It is 1:15. So very grateful for your time and treasure, my friend. You are always welcome with us, and I thank you for taking time. Anything that you want to conclude with before we cut out?
mean, I like to reiterate the same message I end all this with, which is appreciation. I get a kick out of your last question because you're the least selfish person I've ever met in my life. So, so like you don't have to feel bad asking a question for yourself. And I've enjoyed this format and hope to be back at some point and read your prospectuses and trust your community and keep it going.
Awesome. Parabolic, anything you want to say before we hop off? And Michael, if you need to pop off, just go ahead. We're just going to kind of wrap it up around the table.
Okay, I'm not going to pop off, but I'm going to start making my way to the car.
Just so much appreciation. So much appreciation for you, Michael. Thank you for your time. Totally reiterate what you say about Ambassador being the least selfish person on the planet. So just so grateful. Great show. Thanks, guys.
Parabolic, you are the queen, and so grateful that you joined us today. Brother AB, master of his domain and curator of fine art products. Anything you'd like to share before we hop off?
All good on my end. Appreciate the opportunity to chime in. Thanks for doing a wonderful job hosting, Ambassador. Appreciate you.
You're always too very kind. Thank you, AB. Amy, anything you want to promote or talk about? Your website, any great content coming up that you want to make sure you share?
Just the same. I have YieldMax.com. It's a high income comparison tool, and there's this advertisement from YieldMax on there and Quantify funds now. So if you don't want to see the advertisement, you can pay for the subscriptions, and that also comes with extra features. So, So thank you so much for inviting me to speak and allowing me to be here today.
She delivers great content. The website is amazing, and my hat is off to her. ROD, anything you want to share before you continue to grind for the man?
No, just thank you for running the show as usual. You're the best host out there. No one does it better. That's for damn sure. And just in case Mike's listening, I'll make him laugh a little. She take my money. Anyway,
nice.
No, I appreciate the time and everyone and all the speakers. It was a good time. So hopefully more of these to come.
I had a great time, and Michael knows he has a open invitation. Plus, I hit him up on X regularly, so I'm pretty sure that unless we've done something horribly wrong today, that he'll be back and with us again. I do want to plug that tomorrow morning we're going to start the first in a series with Rob, the creator of StockTools.app, and we'll be on tomorrow morning. And then we're going to go ahead and do Wednesdays. So we're going to be on Saturdays and Wednesdays, at least for a couple of weeks, as we go over his tool, kind of deep dive into it and make sure that everybody knows the amazingness of that tool that can help options traders and high yield income investors. So I did want to promo that out. Other than that, I just want to thank everybody for their time. Michael, Parabolic, Brother AB, Amy, ROD, you guys are amazing. Thanks for allowing me to have this platform and share with everybody. We will talk and listen and be with each other soon. Appreciate you very much. Make it your best day ever. Pow, pow.